Okay, guys, so let's begin our session. Let's begin from here. So first, welcome everybody. And like we said, today is going to be a more personal session. We're just expecting a few more people. And first, I wanted to start by telling you about our company. So what we do, this is the partnership that we formed a few months ago. Rakesh is based in UK. I'm based in the United States, so we can really serve both UK, I guess Europe and US as well. And so I've been running the Startup Station for 8 years. My background is in technology and finance. I worked on Wall Street after business school. And for the past 8 years, I've been working with startup founders, most of them early stage, helping them with fundraising support. This is my area of expertise, specifically pre-revenue startups. I've created a specific framework of how to translate startup strategy into financial plan, so that you have a clear way to communicate with investors in terms of what you're trying to achieve, how you're trying to achieve it, what is the path to profitability, why it's going to work, what is the go-to-market strategy, and what will measure success. And so in this process, you're able to bring all the stakeholders on the same page much faster and accelerate the fundraising process. And Rakesh has been focusing on post-fundraising support, so I will let Rakesh talk a little bit about that.
Hi, yes. So this is a quick background to me. I've been before I founded Thrive Group Partners, I was a CFO for a technology company for about 6 years or so. Prior to that, various finance roles for large corporates. And essentially, while I was doing my CFO role, I did all of the sort of stuff that Victoria just outlined. Everything from taking a company kind of from where you are, Derek, pre-revenue into revenue, starting off with angel funding, moving on to more venture capital and corporate venture capital type funding, and eventually I didn't stay long enough to have an exit, but we took the valuation to 200 million before I decided to depart after 6 years. And then since founding Thrive Group Partners 18 months ago, I've been working with a number of companies as an outsourced CFO capacity, and that means essentially helping them scale their companies up, help them raise funding, and set up all of their systems and processes and everything that goes into helping them scale, essentially, and ensuring ultimately, their cash flow and whatnot is running smoothly, and they're not going to run out of money, halfway through the year. And like Victoria said, we came across each other through mutual contact of ours about 6 months or so ago, and we've been working together ever since. And today is, I think, one of the earlier sessions that we're running as a sort of partnership. So that's it, really. That's like it, I think, me, and I essentially help companies for everything from later stage funding onwards onto exit, and help you attract investors, help you get investor ready, and pretty much anything coming into the fundraising sort of round. So should we move on, Victoria, to the
yes, I just want to talk a little bit about the fundraising with the additional resources. So in addition, the Startup Station, which is the US part of the partnership, is both a consulting and advisory, right, and an educational platform. And so in addition to consulting services, we also offer a lot of other resources, such as financial model templates. We have a YouTube channel with videos which we post weekly. It used to be focused on the fundraising journey for founders, but now we started a new section on strategic financial tips for companies that have raised funding and how to manage their money, as well as we have events such as this one. So typically, they have a different format, whether it's an education portion interview with the founder, but this week, like I said, we are trying a new format, which is more of a group mentoring situation. And so, yeah, I think we can start, and we're going to go over the 5 mistakes that startups make. And it's actually extremely common. 80% of founders make these mistakes. And it happens because finance is not necessarily the expertise, right? Everybody talks, you need to have a product, and so you must have product expertise, whether it's a hardware, software, or if it's a physical product. But finance is a separate expertise, just like marketing and sales. And so if you don't have that expertise on board, you're in danger of making some missteps, right? And some of these missteps can be pretty detrimental to your company. So Rakesh, please take it away with mistake number 1.
So, okay, thanks, Victoria. So the first mistake, as I'm sure you've already seen, is poor handling of cash flow. And poor handling of cash flow really means, essentially you mismanage your cash flow. You find that you are running out of money. There's not enough money coming in for whatever reason, and there's not enough money coming in either from revenue sources or from investor sources, and there's way too much going out the door. And there's a few reasons for this. Some of it is just generally bad planning. But some of it is more to do with you have poor financial processes and controls in place, which isn't unheard of for a startup, especially early stage startups. Your financial systems are not correctly utilized. And the most important one, I think, is the data you have, you're not entering in a timely fashion. So you come across companies who are not completing their month-end process for many, many months. Which leads to them not really understanding how much money is actually going out the door, and they equally don't understand how much money is coming in. So what that essentially leads to is that you end up miscalculating how much money you think you needed over, say, the next 6 months. It ends up being a lot more, and you find out that you actually need to cut your expenses drastically, which often means that you end up having to, remove people, ask people to take pay cuts, or you end up as in a consequence where you maybe not be able to pay certain suppliers. They may be key strategic suppliers of yours, and therefore you invariably may damage some of the key relationships with your supply chain. And none of those are good. So the general action plan for that is keep someone on hand or company on hand to make sure that you are completing your month end on time. So that is essentially have someone develop your financial processes and controls to ensure you have accurate reporting and also timely reporting. And then also on top of that, produce budgets and forecasts, which then will lead you to producing cash flow forecasts, and keep these up to date. Update these at least once a month, so that you understand how much is coming in for accounts receivable, how much is going out the door via accounts payable, and what any future cash needs are. And ultimately, that will lead you to being able to manage your cash a lot better, and hopefully not running into any cash flow difficulties in the near or midterm future. That I think is probably all I'm going to say on that point, but I will kind of open it up briefly to everyone if anyone's got any questions that they want to go over, or anything I said that may not be so clear that they just want me to clarify.
Yeah, I just want to add, for those who don't have a finance experience, what those terms are. So accounts receivables is the credit that you extend to customers, right? So for example, if you're working with B2B customers and then you sell them something, they may pay you 1 or 2 months later. This creates a difference in timing between you make a sale and the time when you get the cash, right? So that produces this credit on your balance sheet, which is called accounts receivable. Accounts payable is the reverse side of it, when you on the other side have credit from your suppliers or vendors, so you have more time to pay them. Ideally, you would match those, so you would actually not have to pay your vendors if it's possible to do before you collect money from your customers, but it's not always possible because they may not be for the same product, etc., etc. And then I guess the other important impact on cash flow would be inventory, right? It's also part of what we call working capital. We're going to discuss it a little bit later. And working capital is the capital you need to run your company because of those differences in timing when cash is coming in and going out of the company as it relates to the company's operations. It's not the same as your operating expenses. It's specifically related to credit that you extend to customers or get from suppliers, right, which we just discussed, or inventory. And just to make a last point, as a startup, you don't really have a lot of latitude to make mistakes, right? So when you don't have your financial infrastructure set up properly, you end up in these situations, right? Investors, you may be in a situation where you will have to go back to investors and ask for more money. And this is not a good situation to be in, right? Because it's not because you're asking for more money because you're doing great and you need money for growth. You're asking for money because you mismanaged the capital that they gave you, right? And this may result, maybe they're going to give you a little bit more because they don't want to lose their entire investment, but most likely, if you're not able to catch this problem in time, you will go out of business. And that's, part of the reason why a lot of startups fail, right? And there's many reasons, on the revenue side, like they can't get traction, there's problems with founders, there's legal foundation, et cetera, et cetera. But there's also problems that are related to operations, which can absolutely be avoided. And we wanted to do this workshop to talk about this problem so that, founders are in a better position to succeed and you are in a better position to succeed. Okay, let's go to mistake number 2.
Thanks, Victoria. And just to reiterate, that this is really the number one, for me, this is the number one reason why companies go out of business, because they don't manage their cash flow. Sometimes you can have a great company, you might be doing really, really good sales, and you might well be profitable, but because you don't deal with cash flow issues, you might find you go into administration. And it is the number one reason why companies fail. So let's move on to number 2, please.
Yeah, no, actually, I just had another thought that I want to finish, which is, I'm advising a company right now, a nonprofit that's been in business for 20 years, and, really should have all the processes set up. However, what's happening is that they have multiple departments within their company, and the department heads who have direct access to spending don't understand how much they can spend, which results in a regular overspending. So this lack of controls, right? So we're talking about that you may not have a financial system set up, but even if you do, but if you don't have the controls in place, which tell the people who have access to money how much they can spend and what the policies are and at which point they need to get an approval and from whom, it will result, even an organization that's been around for a long time, not just for startups, in significant issues. And what happened with this organization is that they got into a turnaround situation, right? I mean, part of the reason was that they were completely mismanaging their costs and as a result, cash flow, and another one was on their revenue billing side. But that's, outside of the scope of this workshop.
Very interesting. So number 2, so this is just so everyone understands, this is still dealing with cash flow, but it's sort of getting into more detail around cash flow. So within your cash flow, a key element of how you manage your cash flow is something that is called working capital. And working capital is primarily 3 things. And those 3 things we touched on the previous slide. And those are accounts receivable, accounts payable, and the additional one is inventory. Derek, you probably know all about inventory by now, being a hardware startup. So as Victoria kindly mentioned previously, accounts receivable is essentially the money that or the credit you've extended to your clients. So if you make a sale for $5,000, you might not get that money up front, but you will eventually get it in 30 days, 60 days, whatever the payment terms are that you agreed with your client. Sorry, David, you're asking if cash is included within your working cap, and actually, no, I don't often include it. Cash is just available and is the product of your cash flow, but your working capital is just literally your accounts receivable, accounts payable, inventory. You may have a few other things in there from time to time, like these are more accounting based things like accruals and deferred revenue, things like that. But but mainly it is accounts receivable, payable, and inventory. So going back to accounts receivable, that's what you extend to your clients, and accounts payable is essentially the opposite of that. So that's when your suppliers extend you credit, and inventory is essentially just saying that's another form of cash. So instead of having money in the bank, you have your money sat in a warehouse in inventory, which isn't as good as having it in cash, basically. So like in an ideal world, you would have hold as little inventory as possible, and you would be hoping to big car manufacturers, I'm sure you all know, operate very effective just-in-time delivery systems. So they never really hold that much inventory. And the reason they do that is because of working capital. So all of this is based on pretty typical corporate finance theory about holding as little as possible within working capital. Therefore, there's much more cash available in the business, and therefore you don't need to be tying up resources on things that shouldn't really be using cash. So that's like a brief background. So overlooking working capital. So what the reasons for this is, a lot of companies who are growing very quickly, they don't have finance departments who fully understand, or they might not have finance department at all, or they might have fairly junior resourced finance departments. So they may not be very well versed in looking after working capital. I see Victoria's putting a few messages in the chat, so I'm going to ignore those for now because and just crack on with the presentation. But
yes,
I'll come back.
They just asked if cash is included or not, and I explained. Don't worry about that.
Yeah. Yep. So working capital. So working capital ties up too much of the company's cash resources. There's not enough attention towards improving the working capital cycle. I'll come on to in a moment what working capital cycle means, and you've got too much of your cash tied up in stock and inventory. Working capital cycle is essentially a pretty simple formula, or pretty simple sum. All it is saying accounts receivable less accounts payable less your inventory. And essentially, if that number is positive and it's month on month increasing, that's generally a good thing. If it's decreasing, it's generally a bad thing because it means you're tying up more and more money in inventory or accounts payable. A lot of companies don't mind having a highish accounts payable as long as the accounts receivable is low, because essentially that's money that you owe people. So you could, some companies, they try to have their clients paying them on 30 days, but they pay their suppliers on 60 days. And funny things. So like, I'm not a fan of that because I don't feel like you should abuse your supply chain. But you do see larger corporates doing that type of activity, or even having suppliers on 120 days. So the consequences of having poor working capital is your company has cash flow issues despite you having strong sales. So you may have you might be selling, if let's say you're doing 1 million, 2 million, 3 million in sales, but you're not collecting the money quick enough. So you've got all this money extended to your clients, and they might be on 30 days, but they just haven't paid you. And because you're not running effective credit control, that money's just sat with your clients and they're not giving you the cash. It's not in your bank account. And you're finding that because of that, your cash balance in your bank is really, really tight. But at the same time, you might have 1 million sat in accounts receivable. Often companies in that situation can go into administration, which is why I put companies at risk of going into bankruptcy if not corrected, or into administration. So the action plan here is you focus on the 3 elements separately. For accounts receivable, you aim to essentially what I would call have a sort of leading credit control function where you are collecting the cash as quickly as possible, and essentially you're aiming for 30 days or less, and you can incentivize your credit controllers if you have a big credit control function to actually actually have bonuses and all sorts of other metrics that you can measure them on and reward them on if they're doing a great job. A lot of companies sometimes they are keen to pay some of their suppliers, and they pay them not only on time, but they pay them early. And when you're having cash flow issues, I'm not a big fan of paying anyone early. So you should always pay your suppliers bang on time as per the credit terms to make sure that you extend any free credit that you have available to the maximum possible. We've added here avoid duplicate payments to vendors. So this touches on what we said previously. Where if you have poor financial processes, and this is fairly common in startups where you accidentally pay a vendor twice for the same invoice or whatever it may be, and in doing so, you remove money from your company, and you may actually struggle to get that money back. And I've seen this happen to some startups where they've overpaid a supplier by 100 grand by accident, and actually struggled to get that money off them immediately. And it's been a couple of months before they got it back, and that's led to them having cash flow issues. And then the final thing is, in a startup where you do have inventory, often what will happen is you might overbuy your inventory, because then this can be for several reasons. It might just be because you're small and you're trying to get economies of scale from the supply chain, but it could just be that you misforecast and you just bought too much, and it might end up becoming stock which end up becoming outdated, especially if it's an early version of the product that you're manufacturing. So we always aim, for all companies, my advice is always aim to have as low a supply of stock as you possibly can, or inventory. It's not always possible when you're a very early stage startup, but where you can, you would aim to have it as minimal as you can possibly have. And if you do all of these things, then there's a lot less chance that you will mismanage your working capital, which will mean that you will most likely not follow into any sort of cash flow difficulties. Victoria, do you want to add any comments to that?
Yeah, this was very comprehensive. Thank you. I think the only thing I would add is that, how do you know if you are waiting too long to collect money from your customers, right? And this is going to be dictated by the industry in which you're in, right? So sometimes the customary time to collect will be 30 days, and sometimes it will be 90 days. And for some bigger projects, so let's say if you work with the government, it can even be 180 days. And this is very important to be aware of as you're doing your financial planning, because of course this affects how much money you need, your funding needs, your cash flow forecast, etc. And then on top of that, we have to do all the things that Cash was talking about. So the next mistake, yeah.
While you mentioned that, Victoria, let me just say one final point. When you're negotiating with if you're a startup and you have corporate clients, as Derek, you alluded to, or you mentioned, don't be afraid of just saying to them when you're negotiating a contract, we're a startup, we need to have shorter payment window, because I've seen that when I've been negotiating those same contracts, I've said that, and they've actually said, okay, yeah, actually you make a good point. You guys going out of business because we didn't pay you is not really what we want. That's not what we want out of the relationship. So they might actually go from 60 days to 90 days, or 60 days to 30 days, or 60 days to 45 days, or whatever it can be. And that often does work. Just saying, look, we're a startup, this doesn't work for us. As long as you find some sort of half decent person within the finance team over there, they will often be sympathetic to that. And the other thing is, make friends with someone in the finance team in those companies to get your invoice paid sooner.
Yes, because it's not their personal money, but they have so many things going on that it may just fall off the back of the burner. Yeah, that's absolutely right. In general, it's good to have relationships, right? This is not just to get your invoices paid, but this can be that you will find out how to upsell, a new product or extended term of your service, etc., etc. So the third reason that is very common, and this is for both startups and businesses that have been around for a long time, and not understanding business drivers and their financial impact. So why does this happen? It often happens, okay, because Even when you have a member of the financial team, but they come more from an accounting background as opposed to finance background, the way that they do projections and the way that they do the modeling is very much focused on the reporting and reconciliation, as opposed to modeling your strategy and evaluating its financial impact. So when you have a hard-coded financial models, right, you then have models that can only function as, did we meet the results, did we not meet the results, but you don't really understand why. Okay, and when you don't understand why, you are then missing a lot of the business intelligence that will allow you to act and correct those parts in your strategies which are malfunctioning and capitalize on those parts of your strategy that are working well, right? And so what happens when you have situations like this is that your financial models and systems that are based on those financial models are disconnected from the company's strategy, or you may be tracking wrong inputs altogether because you don't really understand what to track. As a business person, you may not have that knowledge. As a finance person, if you have the proper background, you should, but what we're finding in the industry is that that's not the case. And businesses miss a lot of the intelligence in terms of why they're performing the way that they are, why they're getting results the way that they are, because they're not tracking their strategy. They're just tracking the output without understanding why they got it. So what happens as a result, if you don't understand what's going on, you may experience reduced profitability, decreased cash flow. And if you continue to make bad decisions, right, you continue to execute the strategy without, tweaking it, without addressing what's going wrong, right, and capitalizing what's going right, eventually you will fail, right? Because as a startup, like we've discussed before, you don't have a lot of opportunity for a failure. But even as a company that's been around for a few years, you also have, a cash runway of, this many months, right? It's not going to be forever that you can continue making bad decisions. And that's why we see companies, right, even big companies, which end up in trouble, right? Even after they've been around for a few years, right? They execute the strategy and they're not able to react fast enough to market feedback, right? And the bigger the company, the more complicated it is to do, actually, even if you have the information. But even for smaller companies, you have to do it, and you have to have the information to do it well. So what should you do to avoid the situation? It's totally like all of the things we're talking about here. The good thing about them is that they're completely avoidable, right? If you just set your infrastructure right, you will have all the information to run your business well. And so what you should do is to connect strategic decisions to concrete financial inputs. For example, if you want to generate X amount of dollars or pounds or euros in revenue, right? How will you do it? What is your go-to-market strategy? What is your sales cycle? If you're selling B2B, or what is your marketing budget? What is the marketing mix? What is the expectation from each marketing strategy, right? You connect it to specific financial inputs. You then create business logic, right? So what is the impact of your decisions, right? You formulate, right? You create business logic, converting those inputs into financial results. So now you have an engine, which is a business intelligence engine, which converts your strategy into financial data. And this is your financial roadmap, right? So if you track those inputs now through your financial systems, and you have the reporting tools to analyze the results, you will be able to have a complete picture of what's happening with your business, right? From all sides. And the last point is, of course, you have to determine metrics to measure your success so that you understand whether you are on a path to achieve your goals or not. Rakesh, do you want to add anything to what I said?
Well, that was very, very thorough. So I don't think I can actually add much more to that. I think all I will say is time and time again, I see lots of companies looking at just the outputs of their P&Ls, and much like you say, Elena, without very much analysis going into what the drivers are, and because they don't build up their forecast from that, they really struggle to understand what it is that's actually happening in the underlying part of the business, because they're only focused on the financial aspects. And because of that, it just makes it very hard to understand how well you're executing on your strategy.
And I mean, even if you are a pre-revenue, right? So there's two sides of a financial management. There's a revenue side, right, which is extremely important. You need to understand if your go-to-market strategy is working, and to manage your billing cycle, collection of money from your customers. And then there is a cost side that we've talked a lot, right, in the previous two slides, that a lot of the issues actually stem from mismanaging of costs, right, which result in management of cash flow, and then it leads to all kinds of problems. So even if you are a pre-revenue startup, you still need to have all your processes set up correctly. First, you're going to only track costs, and then you need to be in the position to start tracking revenues when you're ready to start generating money, so that you're not scrambling. Instead of growing your company, you focusing on the completely not the wrong things, but things that take away from the company's growth. And if you do it badly, we've just discussed what's going to happen. So the next slide mistake is connected, right, to understanding business drivers. It's more on the output side. It's your unit economics. So what is unit economics? It is your profitability metrics or cash flow metrics, or cost metrics per unit of sales. So per customer, per user, per product, per something. And why is it important? Why is it important to understand? Because you want to understand, if you're not making money per unit of output, then you're building the wrong business, right? And it's even if you're building a forecast and you're thinking, okay, we're going to expand, we're going to go to a new market, we're going to launch a new product. If you're not making money on that level, there is no way you're going to make money overall, whilst all the other costs will add in, such as the cost of running your business, which don't really depend on an individual unit of sale or individual customer. And so why does it happen? Again, it stems from the lack of finance knowledge, not having the right expertise on your team, which is totally correctable. And so either you calculate it completely incorrectly, or you track the wrong inputs and you don't have the information to calculate it correctly, okay? Because you didn't do the setup right. By the way, if you do the setup wrong and then you operate your business for 2 years, it is very difficult. Okay, I wouldn't say very difficult, but it is more difficult to transition to the right systems then, because you have a lot of legacy data which needs to be converted and analyzed and put in the right place than if you do it correctly from the beginning, right? So I highly encourage everybody that once you have the funding, and even as you start spending money, to have your systems set up correctly, so that you don't end up in a situation where what you need is not what you have, right? And then investors are not going to be happy either, right? Because remember, all investors are very strong finance people, and they're looking, while they're also helping you to change the world and achieve your dreams, they're also looking to make money, because they're responsible to somebody else for their decisions, which are their investors, right? Unless they invest their own money. So what happens as a result? All the usual suspects. You have a business that doesn't make sense. And the way to correct it is actually pretty simple. You need to determine what the right formulas are, what are the right ratios to track, what are the inputs that need to be, that you need to have for this, how are you going to calculate the outputs, and then you need to change your financial systems or review them and make sure that you can get all the information. And if you can't, then adjust them accordingly. Do you want to add anything, Rakesh, to what I said?
No, I just really just absolutely agree with you that trying to fix this 2-3 years down the road is always very difficult. It can be done and we do it, but I just did it for another client, but it's so much easier trying to just do it right first time. But I can absolutely appreciate when you're early stage startups, the focus is often not on getting this part right, and it's about just getting the customers and getting things done. And often you worry about the finances at the very end. So I can appreciate why people don't focus on it, but the ones who do, that tend to find their lives a lot easier down the road.
And I mean, even as they're doing it, it allows them to react faster to market feedback, because they have all the information in place to react, to evaluate what's going on. Okay, so let's go to the last slide. And the last slide is underestimating your funding requirements with no contingencies in place, right? And then it's all related together, right? It's all related to bad forecasting, not accounting to working capital, not understanding unit economics, not understanding your business drivers, right? And then do you have, are your revenue goals in line with the capital needs that you have in mind, right? Do you have enough money to even reach your revenue goals? If you haven't built your financial models properly, you haven't built that logic that translates your strategy into financial results, you have no idea, right? Because a lot of the times, and I will actually talk about the two biggest mistakes in startups financial modeling that I see in there on the revenue side. Of course, side is typically simple. So when you are pre-revenue, especially when you have very little financial data, there's two ways that companies model their revenue. One is that they assume a certain growth rate for their users, right? Which comes completely arbitrary just because it seems like it's a good idea, whether it's 100% initially because the numbers are low, and then it reduces to 50%, and then it goes to some steady state number, let's say 5% or 7%, or whatever they think is achievable. That's one way to model demand, right? And then you just apply whatever price and whatever you try to sell them to that number. And the second way is you say, okay, well, my total addressable market is 500 million. In the first year, I'm going to capture 0.01% of market share, and I'm going to grow it. Again, it's based on some arbitrary assumptions in terms of what the founder thinks is achievable, right? And from both perspectives, the response that I usually get is that, well, we don't know. This is, this numbers don't make sense anyway. They're going to change. Doesn't matter what we put there as long as the result is good. What is the problem with both of those assumptions is that with both of those approaches is that those are not linked, okay, to the company's strategy. They're not linked to the amount of capital they have. It's not linked to what exactly they're going to do to generate those users. So as a result, you have a projection that can be applied to any number of businesses, right? Without understanding the underlying business model and what it takes to get those users or those customers to convert, right? And so when you do that, as a result, you have numbers that are not justifiable, not credible, and that's why investors often ignore those projections because they all look good, but they don't understand how a founder is going to achieve it, right? So, and when you build the models in the right way, you think through all the parts of your business and you translate it into your financial plan step by step, you then don't have that problem, right? And you then can also estimate your funding requirements correctly because you thought through everything, right? And so like the common thing that people miss in their funding needs is that they overlook or underestimate certain costs. That's very common. Specifically, they don't include working capital. It's a very common mistake because working capital is misunderstood, right? It's not an intuitive thing if you're not a finance person, and then you don't plan for contingencies, right? And so when you you may not have all the proper information about your business, and then from whatever information you have, you may do a bad job of evaluating it, right? As a result, you may come up with funding needs that will not allow you to achieve your goals, right? There's nothing wrong with raising 100K, 200K, 300K, 500K, whatever currency you are. That's not the issue here. The issue is that that amount of capital has to get you to a certain point, right? And as a founder, it's your responsibility to think through how that's going to happen. So when you do the modeling the way that I described, or if you don't plan for contingencies, if you do a bad job estimating how you're going to spend the money, you're not going to reach that goal, right? So as a result, you're going to upset everybody. You're going to upset your co-founders, strategic partners, customers, investors, and most likely everybody's going to get disappointed, and then you will have to close your company, especially if that's your first round. Now, of course, sometimes you cannot predict what's going to happen. You may have to pivot. In that case, sometimes it's justified to not reach your goals and ask for more money, but most times it's not, right? Most times it's related to execution. And this is what we are trying to avoid here. So what is the plan here is to do your forecast correctly, include your capital expenditures, which is spending on your assets, computers, equipment, furniture, if you have an office, like all other things. For tech startups, it's a small expense. The capital expenditures for product startups, it would be a large one. And then involve your team in budgeting decisions. You may have an expertise in one area, let's say that you're an operations person, but you're not a tech lead. So you may not know how long it's going to take, who you need to hire. So if you make the decisions in terms of how your team is going to grow without involving somebody who understands what it takes, or for example, if you need to grow your marketing department or sales department, right? If you don't talk to the people intimately involved in those areas, you will not have all the information. So it's very likely that you will make bad decisions. And then on top of that, we recommend that you include a contingency so that you account for the unexpected, so that if things don't go as you would like, you're not immediately in a position where you're experiencing liquidity issues. You have some buffer to react and to catch your breath. Rakesh, did you want to add anything?
To be honest, no, that was incredibly thorough. So no, I won't take up any valuable time expanding on any of that. That was really good.
Okay, perfect. Well, we're going to spend the rest of the time talking to you guys about the questions that you had. And I know that David had a question, and then I would love to learn more about Patty and about her startup and what she's here. And I guess, guys, about any pain points that you experience specifically right now. So David asked me, what is the biggest cause for this mismatch? Finance, not communication. So I'm assuming that the mismatch is between a strategy and finance. So yes, I mean, I think the cause for this mismatch could be twofold. One is business may not be communicating with finance as well as they should, but I think mostly it's on the finance side where the finance is not working properly and is not creating the right systems and tools in order to give the business the information that it needs. So it can be that you don't have the right people in your finance department, or business and finance aren't talking, and either through the lack of trust, the personality issues, or business does not feel, what often happens actually is business leaders don't feel comfortable with numbers. I experience that a lot, and therefore they don't want to get familiar with them. They don't understand what they mean. And the finance people, because they're often technical, they cannot really explain what they want in a way that non-finance people can understand, and so that contributes to the gap. That is also should be addressed through finance education. In fact, part of what I do is I train staff to understand, and the boards of directors, which often don't have financial background, to understand financial results and to make decisions based on that, so that the two parties can talk comfortably and not be afraid, right? So the finance isn't afraid to ask business questions and tough questions, which make them feel uncomfortable. Or not uncomfortable, but challenge a little bit what they're thinking to make sure that good decisions are made. And at the same time, business understands what's going on, right? They're not afraid to ask questions, not afraid to ask for the data to be presented in a certain way, so that they can use the information from the finance department in order to drive their business forward. So Patty, please tell us a little bit about yourself and your startup and why you wanted to attend this workshop.
Hi, sorry, actually it's very late for me over here. I'm actually in Asia.
Oh,
So
Okay.
yeah, no, I'm just we are in the health tech industry, and basically, I just want to learn more about finance. It's very helpful to understand the pitfall that could happen within a young company. So yeah, I think very, very, very helpful to hear all the points that you guys have just raised. Thank you very much.
Sure. And then are you a pre-revenue or revenue generating? What is your stage?
No, we're in pre-revenue stage. So we're still quite deep in the build side. Right now we're recruiting our team. So a lot of it is on the spending side rather than, getting revenue. So it's good to actually have these in mind as we continue to move forward.
Got it. And then may I actually ask you quickly, how did you find out about this event? Through Startup Station or Ask Global?
I think it was through Startup Nation.
Startup Station. Okay, perfect. Yeah. Okay, yeah, wonderful. Well, thank you. If you're in the pre-revenue stage, that we have, and especially if you want to learn finance, the Startup Station offers finance classes for entrepreneurs with no finance experience. And if this is, guys, unique, we can talk, offline about you learning some accounting, financial modeling, evaluation, that could be helpful. And then if you need to do some initial setup in terms of your systems, when you raise funding, that could be a good next step to avoid all the problems that we've been talking about.
Yep, good to know. Thanks very much. I'm actually going to drop off now because it's actually close to almost 1 o'clock for me.
Oh,
so,
wow.
Okay.
Yeah, so I will I'll reach out subsequently. Yeah. Thanks, guys.
Okay. Well, good night, Patty.
Good night. Bye.
Thank you. Bye.
Okay, so Derek, do you have anything that you wanted to discuss in terms of the issues that you currently have?
Yeah, I mean, look, I think first of all, thanks for all the info. I think I'm pretty much, I've been through this before, so I'm very familiar with points 1, 2, like operating financial discipline and prudence. We've got very good accountants. We've got very good, our secretarial work is very solid. I think the parts that are of interest to me, and I think you pushed them in, made some notes here, particularly 3, 4, and 5. Your mistakes 3, 4, and 5. We find ourselves in a very awkward position, and perhaps this is outside of the scope of this, this conversation. We can schedule
separately. For a chat afterwards and talk. Yeah, but go ahead. We have a few minutes now.
Okay, well, very briefly, because we're a hardware business with a SaaS platform, and we're pre-revenue. So one of our biggest issues at the moment is how much funding to raise and when to raise it. So, building hardware is far more complicated than we ever anticipated, but having now passed that hurdle, we're literally manufacturing as we speak. The products will be ready in September. We found ourselves dealing with minimum order quantities and the kind of things that you touched on in the inventory places, which caught us by surprise. It's not even economies of scale. It's way more difficult than that. And so
the factory will make you order a minimum amount, and there's no way around that, right? Yeah.
So what happens is timing. It becomes a timing issue because we currently are building 1,300 units. But if you have too much stock, for obvious reasons you've mentioned, this is not a good thing. The flip side is you have too little stock, it will take another 3 months for us to fire up the production line again and produce more stock. And I think for us, it's a matter of raising funding to cover that process.
Yeah.
So the seed rounds that we've raised before have been plenty to get us to the point where we are right now. And I think we're still in a very difficult position where, because we haven't gone to market, it's very difficult for us to estimate the sales, other than by all the things that we're doing right now in our marketing activities, which is reaching out to clients, getting ideas. But because the product's not shipping yet, no one's placing orders. Yet we're having to kind of predict what the orders are going to be, having not sold a single unit. So I think that would be our biggest challenge at the moment is trying to navigate that and when to seek additional funding. So we're going to run out of our first runway at some point in time. Well, I mean, not at some point. I don't know exactly when we're going to run out, but do you go raise? I've not raised funding before. We've always had our one startup kind of fund the next one, and this is no different. So we've never raised external funding before, and I think that's really the advice.
You always self-funded from the operating cash flow per seat. I see.
Yes, but this one requires external raise without a doubt. It's the magnitude is just so much larger than the previous ones.
Well, what I would suggest is that we connect after, because this is our area of expertise. We can revise, review your financials and help you estimate demand in a way that investors find credible, as well as advise you, given where you are in the runway, a lot of the constraints, what would be a good time to fundraise. Because if you're planning to raise a lot of money, you need to be in a certain stage, right? So maybe ideally, if you're able to generate some revenue, that will be really good to wait until then. But if you're not, but you have customers in the pipeline, that is fine too. It all depends on the raise and how your financials look in general in the state of your business. So we will reach out, maybe we'll schedule 30 minutes and we'll talk, just in terms of where you are. And then if you're interested in one-on-one help, we can definitely do that.
Definitely, and also particularly on the kind of the funding that we might be seeking, like whose doors
that
should we
all
knock
comes
on?
out from the model, right? If you build the model, like when I've talked about it, you build this business intelligence engine that represents your company, almost like a company brain. And it comes from my computer science background, where I almost built models in an algorithmic way. So you have this tool, right? And it will tell you all the information you need, when you go into break even, how much money you need to get to what point, how many raises you need to go through given your current goals, etc. And it will just take all the information that you have at the point. If you have some course that you've spent and whatever, it will be part of the model and part of your balance sheet, and then we'll incorporate your strategy in terms of estimating demand. And for you, it will be extensive hardware through distribution channels, as opposed to SaaS model or data model like it would be for tech stuff. Yeah, so we'll follow up separately, and we'll continue talking. And thank you so much for joining. It's been a pleasure, Elena. I think you can.
Thank you, Derek.
Recording.
Yeah, thank you, Rakesh. Thank you very much for the information. Much appreciated.
Yes, absolutely. Okay. We're happy that it was useful.